In this section, we are interested in taking a look at three particular banking variables: the reserve ratio, the reserve requirement, or the required reserve ratio, and excess reserves. So let's go ahead and take a look at each one of these a little bit more in detail and the formula that's going to be attached to them. So here, let's take a look at the reserve ratio first. Reserve ratio. With the reserve ratio, this is, once again, by the name that it sort of implies, just the percentage of a bank's total deposits that are held in reserves. So we're going to be taking some type of ratio or fraction here. So the percentage of a bank's total deposits, total deposits that are held in reserves. So here, there are two places where a bank can actually hold reserves. We've already hit on one of them in our previous video. So here, either as vault cash. So remember, when you think of a bank, they have a huge vault in the back, and that's where they can hold a portion of their sort of deposits. So this is going to be seen as a part of their reserve, so vault cash. Or they can hold it as deposits at the regional Fed bank. Or as deposits at the regional Fed bank. At the regional Fed bank. So if a smaller commercial bank actually wants to hold money or reserves at a regional Fed bank, they can absolutely do so, and that is going to be considered reserves as well. So essentially, the regional Fed bank acts as the bank for all the smaller commercial banks. So if TD Bank, Wells Fargo, Chase, SunTrust, if they all want to go ahead and deposit money at their own bank is going to be the regional Fed bank for their particular region. So there's 12 regional Fed banks, and we'll take a closer look at where they are located in the next few videos. So here, reserve ratio, the percentage of a bank's total deposits that are held in reserves. And remember that reserves can be held as either vault cash or deposits at the regional Fed bank. In order to calculate this out, simply going to be a ratio. It's going to be reserves divided by total deposits. Total deposits. So essentially, you take your reserves, you add the two reserve categories together, you divide it by total deposits, and you will get your reserve ratio there. Next, we take a look at the required reserve ratio. So here, required reserve ratio. Required reserve ratio. And like the name implies, required reserve ratio just tells us that the bank has to, by law, hold a certain percentage of all deposits as reserves. So the required ratio of funds. And also in terms of the required reserve ratio, there are sort of different terms for it. You all may also heard called the reserve requirements. Reserve requirements. And which one we use really just depends on this type of scenario we find ourselves in. So the required reserve ratio is actually a percentage. The reserve requirement is the actual dollar amount. But for our needs, we're going to use them interchangeably with one another. So the required reserve ratio or the reserve requirements are the required ratio of funds. The required ratio of funds that banks must hold in reserves against deposits. So required reserve ratio or the reserve requirement, the required ratio of funds that banks must hold in reserves against deposits. So by law, the bank cannot lend out your entire deposit because the Federal Reserve, the Central Bank of the United States, basically sets these reserve ratio, basically sets the reserve requirement or the required reserve ratio. So here, we can calculate this out just by doing a simple multiplication. We take the reserve requirement, and then we multiply it by total deposits. And typically with the reserve requirement is given by the Federal Reserve. So it really depends on the size of the bank. So for small banks, the reserve requirement is right around 1%. For medium-sized banks, it's 3 to 5%, and for really large banks, it's about 10%. And they really don't change the reserve requirement all too often, unless economic times sort of dictate the need for it. But essentially, this is telling us the required amount of reserves the bank has to hold, either as vault cash or as deposits at the regional Fed bank, in order for them to meet this reserve requirement. If the bank does not meet the reserve requirement, they can actually face very hefty fines and fees from the Federal Reserve. So they always need to hold the minimum amount of reserves as dictated by the reserve requirement or the required reserve ratio. So a simple example that we can give you right here, suppose that the reserve requirement is equal to 10%. So reserve requirement equals to 10%. So the Federal Reserve has dictated that, hey, for all banks within the banking system, they have to have a reserve requirement of 10%. So basically, all deposits that come into the bank, they have to hold 10% of that as required reserves, either as vault cash or deposits at the regional Fed bank. And suppose that you take $100 and you deposit into a particular bank. So the reserve requirement is equal to 10%, and you deposit $100 into your bank. So suppose that you bank at Wells Fargo. You probably shouldn't bank at Wells Fargo because they're terrible. But suppose that here's your bank and you deposit $100 into your account. So how much does Wells Fargo have to hold in required reserves based on these numbers right here? You just follow the formula that you have. It's going to be 10%, so 0.10, put it into decimal form. You multiply it by the amount of the new deposit, which is $100. So that tells us that $10 has to be held in required reserves. $10 must be held as required reserves. So here we have the specific dollar amount, and we also have the sort of percentage with the ratio right here. But here, Wells Fargo has to hold $10 as required reserves, and they can either put it as vault in the cash in the vault, or they can go ahead and put it into their account that they have at the regional Fed bank. But by law, they have to hold $10 of your $100. If they don't, then they can actually face very, very hefty fines and fees. They're basically huge penalties. So they always have to keep a minimum amount, which is known as the reserve requirement. But what happens to the other portion of your $100 deposit? What would the bank like to do with that? And that's where we come to the third and final variable, which are known as excess reserves. Excess reserves. And excess reserves are essentially what the bank holds above the legally required amount. So reserves, the bank holds above the legally required amount. So once again, excess reserves the bank holds above the legally required amount. So suppose that you have $90 right here, so it's essentially going to be the difference between the reserve requirement and the deposits that come in. So if we want to go ahead and find the formula for that, we absolutely do. It's going to be reserves minus the required reserves. So essentially the difference that we have with the numbers that are given to us, we have $100 in reserves. We subtract out the required reserve, so minus 10 right here. So this gives us $90 in excess reserves. And the bank can do whatever it wants with these excess reserves. If they want to go ahead and create some type of buffer, they just want to hold more reserves than what is legally required, that's perfectly fine. But remember that the bank is in the business of gaining money. They need profits. So what they took a look at with these excess reserves is essentially what the bank can lend out. What banks lend/loan out. And basically, if the bank wanted to lend out $90 to another customer, they can absolutely do so. And that is exactly where they are going to be making the most money. So getting some type of interest by making these type of loans. They don't have to lend out the entire $90. They can do a portion of it, say maybe $45 or $50. But essentially, as we can see right here, excess reserves are essentially what the bank can play around with in order for them to do their sort of everyday business operations. So we take a look at three particular banking variables that we are interested in. We have excess reserves, we have the required reserve ratio, we have the reserve ratio, and the formulas that are attached to each one of them. We want to go ahead and see a very big example of how all three of these are going to tie together and exactly what happens when we introduce a few sort of dynamic changes into the bank's T account. So we'll go ahead, work with all three of these macroeconomic variables and do a few examples, mathematical examples, accounting examples in the next video and see what the relationships have with all of them together. So I'll see you guys in that particular video.